Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, January 22, 2018. We're looking at a daily chart of the SPY, or SPDR, which is the proxy for the S&P 500. It's pretty obvious the S&P and the rest of the market had another lift today. The S&P 500 was up about 22, 23 points today. The SPDR was up 0.8% or $2.27. It's starting to sound like a broken record again. The market just continues to grind higher just about each and every day. We did have that one down day, and if you'll remember from last week, we discussed the fact that it was not, in my book, a bona fide reversal day, and therefore the market just treated it as, at least in my opinion, a one-day wonder, and we've been grinding higher for the most part ever since. Today was a nice big healthy up day. This is exactly why we don't try and guess where a top is in the market. We don't try and pick off what we think is a top and short the market. We wait for the market to give us an indication that it's topping out. It will give us a signal. It will be a reversal signal. It will be a reversal day. It will be a signal of a trend change. It will be something that we can trade against, meaning we know where we're wrong. Right now, the market continues to grind higher, and you know what I'm going to say next? The trend is your friend until the very end. If you're wondering what this horizontal line represents at 272.92, that's the level that I believe the market will get in trouble if we close below that level. We're nowhere near that level now. We're about 10 points away in the SPDR and about 100 S&P points away from that level. Now, over time, that price, that horizontal line, is going to creep higher over time as the market goes up. The point in which we get into trouble that we can't close below will go up. But right now, that's the level that we have to watch for. It's nowhere near price. We really technically have nothing to worry about at this point in time. The market is in a very, very technically strong uptrend. For some people, I know it's hard to believe that the market can continue grinding higher at this pace. But what I've always said, and what people that have been around for a long time understand, the market can go a lot higher than most people think it can, and it can always go a lot lower than people think it can. Right now, we're in the stage where the market's going a lot higher than most people think that it can. Until and unless we see the signal of a trend change, the market is in a bullish uptrend and should be treated accordingly. Let's take a look a minute at the 10-minute chart, and we'll just point out a couple of things from an intraday trading perspective. So this morning, here is the 1020 candle. So we went up into 1020 in the morning, and then we began to go sideways and pulled back a little bit. But what you'll notice is the market never closed below the low of this green candle. Those that have taken my course at Lazy E-mini Trader understand the significance and importance of that type of pullback and can recognize that this was a bullish pattern and that higher prices were likely until and unless we closed below a certain number. Now, we did continue higher, and then we had one more minor pullback in the afternoon. And what you'll notice is this pullback here, you'll notice where that came to. You see the high of this green candle? That's the level that the market tested. And what I always say is markets like to test former breakout and former breakdown areas. This was the point in which the market broke out. Once the market closed above the high of this green candle, it was a bullish signal that higher prices were coming. The market consolidated sideways for a while, and we came back at one point in the afternoon to test the former breakout area, which was the high of that 1020 candle right here. Once we tested that, you see what happened. We tapped it just a little bit, and then the market took off to the upside, and that was all she wrote for the remainder of the trading day. This is the way markets work over and over and over again. These are the things that are taught in my course at LazyEMiniTrader.com. Looking over at the IWM, you'll notice something extremely important today. we closed above the high of the red breakdown candle. This was the candle that determined whether or not we were going to continue in a bearish pattern, and if we closed above the high of that candle, the bearish pattern was off the table. Today, we closed at 159.45. What you'll notice is the high of that candle is 159.41. That takes the bearish pattern off the table. That's a bullish signal for the IWM. Now I want to point something out on a 10-minute chart. You'll notice what happened into the close. The market ramped up into the close. They had every opportunity not to close the market above that level, and they did it anyway. That should be taken as a bullish signal. No two ways about it. Doesn't mean we can't trade below that level, but that's a signal that higher prices are coming. In fact, the IWM was the weaker index in the morning into the afternoon session, and the IWM was playing catch up. In fact, it didn't even pace the S&P 500 today. The IWM finished up 0.5%. The S&P or the SPY finished up 0.8%. So it still was the lagging index, but into the close, in the last 20 minutes of the trading day, they ramped up the index to close above the high. That was extremely important, which for me technically takes the bearish pattern off the table. The transports, my second favorite leading market indicator. The IWM is number 2. Transports are number 1. We still haven't closed above the high of that day right here, and this was on the 16th of January. So this technically still is a bearish pattern. We need to close a day above the high of the 16th of January 16th to take this bearish pattern off the table. Until and unless that happens, the market still is susceptible to lower prices, and that's okay because the 20-period moving average is creeping up toward price, and what we're doing here, the transports really weren't up that much today. They were even up less than the IWM was up, so my two favorite leading market indicators were actually the lagging indexes today, at least against the S&P 500. So we may see this bearish pattern play out yet. It's certainly possible, but even if we did, technically speaking, this bearish pattern plays out to the low of this green candle, and if we did that, you're getting close to home base, which is the 20-period moving average, and if in fact the transports came down to that level and the 20-period moving average creeps up into price, you're going to find support from the 20-period moving average, and that's most likely, unless the major markets are breaking down, that's most likely the extent of the downside in the short term, until and unless we close below the 20-period moving average in the transports. We still could see 200 to 300 points of downside in the transports. Sounds like a lot, but in the big scheme of things, from a technical perspective, no damage whatsoever would be done to the charts of the transportation average. Switching gears, going over to the gold market, you'll see here that what we've been doing is going back and forth in a bullish pattern in this upper range. So what I'm looking at is we have an up move, and we've basically just been consolidating in a bullish formation until and unless we close below the low of this green candle. Let me redraw that. The low of this green candle right here is going to be, at least in the short duration or the short term, a line in the sand. As long as we stay on a daily chart closing basis above that level, this market is consolidating to go higher. $1,320 per ounce is the level of the low of that green candle. Until and unless we breach that and close below that on a daily chart closing basis, then this market is consolidating to go higher, working off some of the overbought condition, letting home base or the 20-period moving average come up towards price. What the market or the gold market is doing right now is simply eating time off the clock. The longer we consolidate underneath this 1338 area, the higher the probability is we're going to make a move to go higher to fill the gap up at 1355 spot 70. On the downside, your two major areas of support are 1320 and then roughly 1305. Those are your two major support areas on the downside. If those are breached, we have trouble in gold. You don't want to be long gold. If in fact we're closing below 13.05. Moving over to crude oil, as you can see, similar to all the other markets, we're in the upper range, above all the moving averages, away from home base. Home base is creeping up to price, and that's what they're doing. They're just eating time off the clock, but this is certainly consolidating for another move higher. There is likely, more than likely, higher prices coming in crude oil. There are two main prices above us that I'm focused on in crude oil. And this is a long-term picture, but the first one is going to be the 200 period moving average, right now coming in just under $69 a barrel. The next area is at $73.78. We'll round it up to $74 a barrel. That's the next major area of resistance I see for crude oil. And in all fairness, we've been talking about bullish patterns in crude oil since way back here when we made this bullish consolidation pattern. We broke out of it, and ever since we broke out of it, it's been a pretty relentless move to the upside. And it coincides with two major things. The first one it coincides with is the equity markets. And we see that from time to time. Crude and the equity markets will trade in tandem or in lockstep. Both are bullish or both are bearish. That's happened before, so that comes as no surprise. And the second area that comes as no surprise is the US dollar. And you see the US dollar has broken down, and the US dollar is once again consolidating to even go lower yet. And I contend that the US dollar can get all the way down to about 88 cents on the dollar. If that happens, you'll see once again higher prices in crude oil. Why is that? A lot of times the dollar and crude oil will trade inverse to each other because globally, crude oil is priced in dollars. So as the dollar goes down and weakens against other currencies, when you convert into dollars to purchase crude oil, you're able to buy more crude oil. It's bullish for crude oil. Conversely, or the flip side of that is, a bullish dollar will be negative for crude oil. So my point is, when the dollar actually bottoms and starts back in the upward direction, that will be at some point in time when that does take place, that will have somewhat of a cap or be negative for crude oil. Right now, crude oil is pointed upward, it's bullish, the dollar is pointed downward, and it's bearish. We did have an earnings announcement today from one of the bellwethers, Netflix. This is one of the fan favorites, and Netflix stock is responding well to their earnings report, currently up $28, $29 from today's close. That could certainly bring a lift to other stocks in the NASDAQ tomorrow as long as these gains hold. You can see here on the hourly chart, I switched over to the 24-hour clock, and you can see the close today versus where we were since the closing bell, up here at $249, having some resistance or finding some resistance at the fat round number of $250. Not to say it can't get through there, but that is a natural area of resistance. There, just to point that out, I'll move the chart over so you can see where price is. And you can see here that the high thus far has been $249.95, just a nickel short of the $250 mark. However, very strong in the after-hours session and can certainly have an impact on other tech and NASDAQ-related companies leading into Tuesday's trading. And with that, it's pretty much everything I wanted to and intended to discuss tonight, so I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.